All right, welcome to the Pitfalls podcast. If you're watching on YouTube, welcome there as well. We got a special episode with Josh from Neo Home Loans, our resident mortgage expert. A lot of questions that we're facing right now. Everything from what's going on with the save injunction and I'm on forbearance. Can I qualify for a home to 1099 income, mortgage, professional mortgage loans. What's the current real estate trend? We're going to touch on all that. Before we do, Josh, welcome back. It's good to have you.
Joe, it's good to be here. Hello, Fick Bucks community. It's great to be with you. And yeah, boy, the whole student loan situation is a mess, isn't it, Joe?
You don't even want to get me started. The last 3 months, I mean, our phones, our calendars have been booked for 2 or 3 like weeks out at a time. I've had to open up different time slots. So yeah, it's been crazy. I mean, on that topic, we will start there. The whole save injunction, people going on to forbearance, being forced onto forbearance. Well, when you're on forbearance, obviously it affects qualifying for a home. And we've had a
Right.
lot of people gearing up to buy a house like during the spring, and now they're all panicking because they're either on forbearance or they're on an income-based repayment plan and they can't recertify their income, which means they're going to get kicked off of it and put into forbearance. So I was like, let's ask the expert. What's going on with underwriting, with forbearance? What could people do? Is there anything they can do? So I was like, yeah, let me ask Josh, see what you got on that.
This reminds me of a Ronald Reagan quote, Joe. He said that I think he said the nine scariest words in the English language are, "I'm from the U.S. government and I'm here to help."
Yep, yep,
So, yeah, I
yep.
mean, there's a lot of unintended consequences in this stuff, and mortgages is one of those spillover places where there's a lot of unintended consequences. So, let's separate out the conventional mortgage world from the professional medical professional loan programs because there's a big difference.
Mhm.
So when you hear somebody talk about conventional loans, that's loans that are usually bought by Fannie Mae or Freddie Mac, which are these big government sponsored enterprises that buy up these huge pools of loans. And they have what's called conventional underwriting guidelines. And they're very cut and dry. There isn't a lot of gray area. Now, and then there's FHA loans and VA loans. Those are referred to as government loans, and they generally have fairly rigid underwriting guidelines as well. And then there's this other pool of loans, which are referred to as doctor mortgages, physician home loans, medical professional loans. And they are more unique and more pliable as it relates to the qualification of being able to be approved for those loans. So the point of me going back and explaining that is if you've been declined for an FHA loan or you've been declined for a conventional loan, that does not mean that you can't get approved with the same set of circumstances for a medical professional loan. So keep searching. So here's what the conventional loan guidelines say about student loan indebtedness and deferral payments. And FHA and VA generally follow suit. Medical professional loans have a whole different set of guidelines. They say that if you don't have a loan that's in active repayment, then you have to qualify based on a percentage of that outstanding loan amount. So if the outstanding loan amount is $100,000, conventional lending may say that you got to qualify at 2%. That means you've got a $2,000 payment. Even if you're making a zero payment, the mortgage underwriter is going to plug in 2 grand for your student loan monthly payments. And that could put your debt to income ratio above the allowable thresholds, or it could push down the amount that you could qualify for. Conversely, when we separate out these medical professional loans, there's some alternative ways to document those things. First of all, if you can show that the loan's going to be deferred for more than 12 months, we don't have to count the payment at all. If you have any type of documentation for from the servicer, what the future payment might be when you go into a future payment option, even if it's a income-based repayment or pay as you earn or any of those things. If you can get the servicer to produce a letter that says, here's what your payment would be if you enroll in that program, then we can use that payment. And if it's 187 bucks, it's 187 bucks, not 2000. So every case is a little different depending on what the credit report shows, because sometimes the credit report shows crazy stuff that's not even accurate, but it's better than the $2,000 and the person qualifies. We don't need any more documentation. Let's roll with it. Every person and situation is different, but the medical professional program, the aperture's this big. Conventional loans, the guidelines and apertures this big in terms of the qualification.
Yeah, we're going to touch on that professional mortgage loan in a minute because that's the questions I've been getting a lot on. But there's one thing that I did want to bring up in there. You brought up the servicer letter. Does it have to be a
Mm.
letter? Can it be a screenshot of like studentaid.gov and your accounts with like the qualifying plans? Does it have to be on their letterhead? Do you know specifically what the underwriters would want? And I know that changes and varies from time to time too, because underwriters change their stuff all the time. But I mean, any inclination on what would be a letter from the loan servicer to prove what your payment would be?
Has to be on the servicer's letterhead.
Yeah.
Yeah, there was a time when we could just go up to the repayment websites and plug in the factors. Hey, we got this many kids and this much student loans, and here's what our income was last year, and we'd kick the calculator. It's gotten so murky that even the professional loans now are saying, hey, we want something from the servicer that says, if you go into this repayment plan, here's what the payment would be, and then they'll take that.
Yeah. That's because probably there's so many bugs on those calculators that they aren't
That
right.
is exactly right. Yep.
That leads us to our next question, right? Like you talked about the professional medical loans, the professional mortgage loans, I should say, the doctor loans, as some people call them. So we get confusion all the time because I'll ask one of our FitBox members that are looking at buying a house, I'm like, have you looked at the professional mortgage loans? And they'll be like, well, I'm not a doctor. And it's like, well, no, they're professional mortgage loans. So those of you that are like DVMs, NPs, PAs, DPTs, RNs, you guys qualify for those programs. Um, so how are those programs? How are the qualifications for them? Just provide, the listeners with some of the details of those plans because there's a lot of questions and then there's a lot of misstatements on social media. Because my experience with this is like one lender might say, no, you don't qualify because
Yes.
they might only do MDs, but it's like that doesn't mean you don't qualify for a professional mortgage loan because there's other lenders. So a lot of misinformation out there. So just give us a quick rundown of the different options on what there are, and then yeah, we'll go from there.
Yeah, you nailed it. Not all banks are made equally, and they have different programs and different guidelines and different designations that might qualify for their loans. So, exactly as you said. Um, in general terms, the 100% financing up to a million or a million and a half in some instances is available to MDs, DVM. There's a couple other subspecialties, but generally that's where, of course, DDS, that's the general 100%. If you're in a subspecialty, so it would be still a professional loan, but it doesn't give you the 100% financing. You may need to put 3% down, or you might need to put 5% down. But the advantage with those loans to medical professionals are a couple of things. Number one, you can still close on future income. So if you're relocating across the country and you want to buy a home 3 months before you have a paycheck stub, you can still do that as a medical professional under those medical professional loans. Number two, if you have student loans, we look at those student loans as we discussed in the previous question, different than conventional underwriting guidelines. Number three, if you have a 1099 or self-employed income component, or maybe you have a locum tenens position where you have, we had a a medical professional last year. He had 27 W-2s because of all the different jobs that he had, and he'd gone to 6 different lenders and nobody could figure it out. And we were able to get that loan through on a medical professional loan that couldn't get qualified for conventional or FHA financing. So there are solutions out there. If you're getting told no, get a second opinion. But just know, if you're not an MD, a DDS, a DVM, there's a possibility that you're going to need to bring in somewhere between 3 and 5%, depending on the loan amount and where you are in the country.
Yeah, that makes sense. So, couple other things that I have questions on those. One, rates, fixed versus variable. That's number one.
Both. Both
That's
are
what I was gonna say.
options. Yeah, both are options. And right now, the arms, and again, these are two different actual loans that I'm talking about. One, let's just call the physician home loan or the doctor mortgage. The other is the professional medical professional loan. The physician product right now actually has a little better rate on a 7-year ARM than the fixed. The medical professional loan, the ARM and the fixed right now are neck and neck. There's not really enough of an advantage for me to make an argument that it would make sense for anybody to use that. And again, we've talked about this on previous live streams, Joe. That's because, we've got still kind of an unusual yield curve out there, and short-term money, long-term money, not that much of a difference.
Yeah, absolutely. And that I wanted to ask that because I got that comment to me the other day about, well, I don't want to go in there because they're only variable rate loans. I'm like, no, they're not. They're fixed rate
No.
too. Like, what
Yeah.
are we talking about?
And
So,
one bank may only have variable, Joe, but keep looking. There definitely are fixed rate options. The other thing I would just mention about that, and I would like your opinion on this. You know, um, most variable rate loans or ARMs will have an initial fixed period. And typically those fixed periods are either 3 years, 5 years, 7 years, or 10 years. So in my opinion, and based on, I've been working with medical professionals now for 15 years, I don't see very many of them holding the same mortgage for more than 7 years. It doesn't mean it never happens, but your trajectory for income, your trajectory in life, in many instances, is such that you've outgrown your home, your family's grown, the market is dipped, and it's time to refinance. There's so many reasons that you may not need that money in 7 years that if there's a 0.5% difference in rate, a 7 year versus a 30-year fixed, I'll oftentimes advocate for the 7 year, especially if people are early in their careers, like no kids, my first job out of college. You're not going to be in the same house in 7 years. You're not going to need this money. You're going to need a different set of money for a different house. And if you can save 0.5% per year for 7 years, you just saved 3.5% of your home value. It can make sense. Just don't be nervous that it's off the cuff and say no to adjustable rates. Just make sure that the locked period, the initial fixed period, meets the amount of time that you think you're going to need the money.
yeah, absolutely. That's what I always advocate is like, I know 2008, everybody's like, never go into an adjustable rate mortgage, but it's like, if you understand how to use them correctly, they're actually could be very, very beneficial to you. Personally, I like 10-year, like 10 ones. I know
Yep.
you just talked about the 7-year fixed. I
Yep.
personally like the 10-year because it just allows you to go through a whole economic cycle potentially.
Yep.
Um, but
Agreed.
that's my own bias, and yeah. One of the questions we did get was how did like right now with interest rates, and I know this varies time to time. But when you compare like a professional mortgage loan against an FHA loan or a conventional loan, how are the interest rates stacking up as of now? Like, where do you see them kind of comparing against those other options?
Very similar. Like almost no delta between the two. In fact, I have a chart pulled up here. I thought you might ask me this. I will. Can I share my screen, Joe? I think you need to give me
Yep.
authorization to do so.
I just gave it to
Um,
you.
okay, great. Thank you. So this is a chart of conforming mortgage interest rates over the last, let's see, going back to December 9th. And I've just picked 30-year conforming, but the professional loans and the MD loans are very, very, very close. I mean, you're talking about like within an eighth of a percent difference up or down, depending on the day. So let's just call it lockstep. But the cool thing is that it definitely looks like we saw what I think is the peak of this interest rate cycle back on about January 14th. You can see mortgage rates were above 7%. Now, that's not the highest they got in the cycle. They were as high as almost 8%. They came down, they went back up to 7. But I think we now have confirmed a downward trajectory. We're down around the 6.5 mark as of the last few days. But the reason why I say I think we have kind of broken the back in this cycle of elevated mortgage rates, Joe, is because we're starting to see real cracks in the labor numbers that are coming out. The BLS employment numbers, the ADP employment numbers. You're starting to see the unemployment rate go up. You're starting to see the number of job openings go down. And it feels like we're on kind of a slowdown in the economy. And that, although scary for those people out there that might lose their jobs, for those medical professionals who aren't going to lose their jobs in a contracting economy, this is a real opportunity because it means that we're very likely going to see lower mortgage rates and higher affordability for housing ahead of us.
Yeah, yeah, and that's I'll put a link by the way in the comments later on to the video that we did in December about like looking out over this year in terms of interest rates because yeah, it might be a good year to look at some home buying. So,
Yes.
um the next question we got, because I know you guys are very unique with this, and I have put this out there in social media, and then I get a lot of questions about it, and I'm like, well, you're the expert on this. Like, let's ask you live. 1099 income. We are seeing a lot of healthcare professionals
Yes.
going to 1099, and traditionally, you cannot buy a house with 1099 income for at least 2 years because you are considered self-employed. Therefore, you have to have 2 years of tax returns. Um, I know you guys don't necessarily do that. You guys allow people
Right.
to go in before 2 years. So talk a little bit about that. Like what would you have to have? Like a month or two, 3 months, a contract? Like what are you guys seeing for independent contractors?
Yeah, great question. And again, we bend over backwards for medical professionals to find solutions and get underwriting approvals and get families in homes. So let me start at where this problem originated. And in 2010, in the wake of the Great Recession, the Dodd-Frank Act was enacted, and part of that legislation, which was meant to protect homeowners from being taken advantage of by predatory lenders. But as many things the government does, there's unintended consequences with that legislation. And one of the unintended consequences was from a provision of that act called the ability to repay rule. And basically, what it says is it is illegal, like literally against the law, for a bank or lending institution to loan against a primary residence where a family is going to be living in that home as their primary residence without proving the borrower's ability to repay the mortgage, proving it. Now, that opened up a huge amount of gray area. Well, what is considered proof of income? And so, what was accepted as industry norm and what Fannie Mae, Freddie Mac, which is the conforming loans, FHA, VA, and most jumbo loans, they've all agreed that to prove a self employed 1099 is lumped in with self employed. In order to prove that income, they want a 2 year history because they want us and 2 year tax return history. So you could actually be self employed 3 years before you get your second year tax return because they want to see not only the income, but they want to see your deductions. And typically, not necessarily the case with medical professionals, but typically self employed people can have huge fluctuations. I mean, they could have monster years followed by really slow years, and they want to average those 2 years out. So conventional underwriting guidelines say 2 years tax returns, average the income over that 2 years. If you don't have it, so sorry. Um, that is not the case with medical professional loans. So we have programs out there that if you have an employment agreement that is predicated upon 1099, but that employment agreement gives you a guaranteed daily or a guaranteed monthly or a guaranteed weekly or a guaranteed hourly and a set number of hours, we can do that loan before you even start your new job, just based on the construct of your contract or offer letter. If you're already on the job and you have those kind of same fixed characteristics, we can do that loan. If where Here's where it gets really tricky, Joe, is if you're on a variable income structure, like you get paid X number of dollars for this procedure or Y number of dollars for these hours and X number of dollars for those hours. So if your pay is kind of incentive based or production based in some way, it gets harder to document and harder to prove an ability to repay. But all that means is that you would need to bring in larger down payments amounts, perhaps maybe as much as 10% or 15%. There's almost always a solution. So if you're newly 1099, newly self-employed, somebody else has said no, you need a second opinion, and we'd love to help you.
Yeah, absolutely. So, yeah, that's a big one. I thought that was huge when you told me that a few months ago that you guys are doing 1099 like without 2 years. I was like,
It's
wow. I was like, I called my wife up and I was like, babe, go to 1099. Like, let's go make more money. We can go and buy a house now with it. Like fantastic. So,
Yeah, it's almost 25% of our business now, Joe.
yeah.
Because it's a real problem out there. We see a lot of CRNAs going 1099, taking multiple jobs, and they're making more money than ever, low debt, high income, great credit, can't get approved for 5 cents for a mortgage. So those are loans that we want to help people with for sure.
We're seeing that across the entire healthcare industry going 1099 and I mean, it's so big right now that a lot of like investment places, so like our partner that we do investments through Betterment, Fidelity, they're all rolling out solo 401ks because of how big 1099 employment has become, especially within the healthcare industry, and that's who their targets are. So
Interesting.
it's a very big thing right now. I mean, with that being said, just some general pitfalls. I know we have a lot of new grads that are coming in here, maybe a first-time home buyer. Some of them might even be a first-time home buyer, like house buyer, but they're not a first-time buyer. Maybe they bought a condo or something. They're looking to transition. Just hit on like two or three pitfalls or things that you're seeing to, basically some words of advice to watch out for.
Yeah. First and foremost, if you're a medical professional, you're relocating across the country, you've got student loans or you're 1099, be talking to somebody who has a professional loan product because those you can get a loans approved on a medical professional product that you cannot get approved with conventional. So that would be number one. Number two, I would go once you've chosen someone that you trust and that you recognize as an expert in that space. Like, if I needed heart surgery, I wouldn't go to a general practitioner for that heart surgery. I would go to the best heart surgeon I could possibly find for that surgery. I'm giving you the same advice. If you have a nuanced loan situation, go to someone who's a specialist in that area. The second thing that I would advise is once you've chosen that person and you trust them, go all the way down the underwriting process. What people tend to do is they want to take the easy route. Let me just put my foot in the water and see what the temperature is and see if I like it in here. And they just do the very surface level approval. And then they find a home and they fall in love. And there's two other offers on the home and they want to close in 2 weeks. And they haven't done any other due diligence because they didn't know if they were going to find a home. Now you're rushing everything into the underwriter. You may or may not have done your due diligence to vet the lender you're working with. And that's when transactions blow up at the 11th hour. I found the house before I found my loan. I didn't vet my mortgage advisor. Now I'm throwing everything together, trying to get it closed in 2 weeks. And whoops, the paperwork makes its way to the underwriter at the 11th hour and it gets declined. And people lose homes and earnest money. Like, go all the way down the path. If you're thinking and contemplating buying a home, get every shred of documentation, get it to your mortgage lender, and then tell them to get it in front of the underwriter. You want an underwriting approval, not a pre-approval, because even people that are good at professional loans, sometimes they screw up. So how do you circumvent that and make sure you're okay? Ask them to get an underwritten approval on what's called the TBD or to be determined address. And then essentially you've got like a blank check. You're approved. You just need to find the house, appraisal, title, disclosures, homeowners insurance. You're ready to close your transaction. So those would probably be my two biggest. And my third, Joe, would be if you can find a realtor in your local community, especially if you're relocating across the country, who works with other medical professionals, and there's a ton of them out there, right? The wife is a doctor, the husband is in real estate, or vice versa, and they work around the medical communities. Those people that are entrenched in the medical communities that are also in real estate tend to be the best of the best. Like there's just some great medical profession focused realtors out there. So having a good team is important.
Yeah, no, definitely great advice. I just seen so many people just completely get screwed on things, and it's just like, and they don't really, and then instead of stopping the home purchase, they're just like, well, we're this far, we might as well just do it, and it's the house that we want. So then they just sign away, and then they kick themselves down the road, and it's like, yeah, so all good advice on that.
put put
The
the work
last
in
question.
early, even if you're not sure you're going to buy a house, even if you're 50-50, we might buy, we might rent. If you're going to travel across the country and you're going to look at housing and you might buy, get that loan done, do your due diligence on your lender before you get to the city to figure out where you're going to live.
Absolutely, absolutely. And I mean, yeah, I mean, every time I have bought a house, I mean, I start those looking into that 6 months early.
Yes.
Just to know what the rates are, what we qualify for, everything ready to go.
Aim before you shoot, right?
Yep, exactly. Last question is just, I know it's a general question. We could take this a thousand different which ways, but what are you seeing in the market? I mean, is it slowing down, picking up? And again, I know this is local based, but just in general, at a national level, like, are more people coming to the market, less people, or people are just, if their houses for sale? Like, what are we seeing just from a high level on all that?
Yeah, so I showed in our last live that we did together, Joe, a picture of or a graph of existing home sales. So this excludes new home construction. These are existing home resales going back to 1995. And 2024 was the lowest number of existing home sales since 1995. There's only 4 million homes sold, which is kind of crazy when you think about a country that has 330 some odd million people in it and only 4 million homes exchanged hands. It's really historically low. And of course, that's because we saw interest rates vacillate between 8 and 7% last year. What's really interesting is, despite that anemic number of sales, we still nationally saw home values go up 5%. That's just incredible to me that we didn't see home prices crash more than that. And I believe that's because 80% of mortgages that are out there are at a 5% rate or below. So people are just sitting and going, hey, I'm not going to fire sell my home. I got a 3% mortgage rate. I'll just hang out until the market comes pouncing back. And here we are, not even 2.5 months into 2025. I showed you the trajectory of mortgage interest rates down more than 0.5% over the last 7 weeks. And the number of mortgage applications is skyrocketing. So I believe for every 0.5% we reduce an interest rate from 7 to 6.5, from 6.5 to 6, from 6 to 5.5. And I think we're going to end somewhere in that 5.5 to 6 range, is I think where we're going to get by time the summer. But realize every 0.5% that a mortgage rate goes down, it is estimated that 10 million more Americans qualify for home ownership. So there are people sitting on the sidelines just saying, I'm not going to buy at 7.5, but when rates get to 6.5, I'm in. And they're waiting to come in. And we're already starting to see that happen. That would also, kind of foreshadow for you, the longer you wait this year, there is potential that you're going to see more competition and less inventory. So just kind of less housing available because there's just not still in most areas of the country, excluding Austin, Texas, and a few other places. There's just not a lot of inventory out there. And when that demand comes back, it'll dry up pretty quick.
Yeah, Austin, we're seeing a lot of inventory.
Yeah. Yeah. And
But
some areas in Florida and some and that could be the perfect storm. Like lots of inventory and mortgage rates going down. That so you can negotiate the price and you get a good rate. Like that could be a good thing.
yeah, absolutely. It will be interesting to see what happens over the next 9 months. So, but yeah, we'll definitely have you back on. I know I just wanted to jump on this because we've been getting those questions a lot recently. So I was like, let's get the expert on and answer these questions. And as the year progresses, definitely have you come back on, give some updates and whatnot, and then go from there.
This is perfect. It's the perfect time to do it. Super glad to be with your community. If there's anything else I can do for any of you, let me know. I also, as just a benefit to any FitBucks community member, we create what's called a neighborhood report card. Joe, I told you about this last time I was on. So if you want a residential real estate report card on your specific zip code or city that you're thinking about moving to, it shows demographics. It shows the trajectory of home prices and forecast home prices. I'm happy to create that for any member. Just feel free to email me at josh@joshmettle.com and I'll create that for you. No strings attached. But if I was relocating across the country and I didn't know jack about the real estate market, I would want to go through that real estate report card and see the strength or weakness in that market.
Yeah, definitely. I'll put that again in the comments in the description and stuff too, your email address, so that way people can reach out to you. And as always, it's been fun. And yeah, we'll definitely catch up soon.
Thanks, Joe. Appreciate you and great to be with the FitBucks community tonight.